we're going to talk about the stock market today. And the reason why I picked the stock market is because one, everybody's, well, I don't want to say everybody, but it's everywhere you look, someone's talking about GameStop, someone's talking about AMC, someone's talking about Black Millionaire, all these things. It's like, okay, well, where do you start? What does this even mean? What is the stock market? And with financial literacy, I mean, there's so many ways that you can take these conversations, from credit repair to budgeting to estate planning. We can literally talk about this for a month and still not get deep. So I just wanted to pick one topic to focus on. And please, please, please stop me along the way if you have questions, or if I'm not using the right terms, or if something's a little out the way. I want to adjust to the audience. So y'all let me know. All right. Okay. All right. Thank you, Andrea, for the feedback. Check my bank account statements all the time. Um, and Andrea's on a budget, definitely pays herself first all the time. And man, that's a win. That's a huge win. And I'd say that you are in the 1% of Americans that do that. Okay, so why are we here? We're here to discuss money and community. I think it's very important for us to come together and talk about it. Money is one of those topics that we don't particularly there. Sometimes there's shame that's associated with money. Sometimes it's connected to social status and class. But when we break down those barriers and talk about things together, it can demystify some concepts, and maybe you're a lot further along than you thought you were, or vice versa, or you get introduced to a new topic or a new tool or a new idea that you haven't particularly heard of before. So that's why I think it's important to talk about money and community. So I personally don't believe in get rich quick schemes or magic pills to solve any of our problems. Uh, if y'all know of one, please tell me, because I've been looking for it, but I don't know if it's out here. I do believe that financial literacy and financial management, it's a marathon. It's really a lifestyle and a life practice. And depending on your personal beliefs, it can also be a spiritual practice. And I just have to say this. Today, I represent myself, and I do not represent my employer, which is Wells Fargo. I am not licensed to sell or advise or consult on any investment strategies or to sell any securities. So I that's not my thing. So I can't really give particular advice on securities. And when I say securities, I mean particular stocks, or make investment decisions or set prices or anything like that. Really briefly, Aaron did a wonderful job of introducing me, but I'm just going to literally breeze past this because I think this slide is good for students, high schoolers, but that's not the audience today. So I played college football at Fresno State, played in the NFL for a little bit for the St. Louis Rams years ago when the team was in St. Louis. I also got my MBA while I was playing, and I majored in finance, and I got my MBA in finance and entrepreneurship. I've been at Wells Fargo for almost 11 years. It seems like I just got there, but man, time flies. I also own a coffee shop in Echo Park, California, right outside downtown LA. Me and my brother, we own it together. It's called Bloom and Plume Coffee. Y'all can follow us on the gram. Y'all can come show us a little visit. We can use all the support we can get. And then I also am a real estate investor. So that's a little bit about me. And okay, I wish I could spend more time talking about what Dr. King calls the other America, but I mean, there's just so much data here, but we only have a short time. So I'm just going to focus our attention on one slide. And when I see this slide, and when I see this chart that we're looking at, my heart, okay, Aaron Wilson said, this is also, I live in Silver Lake, we'll be stopping through. Please, I'm going to try to go over there after this presentation, actually. So yes, we're right around the corner from you. Um, This is a chart on the net worth of Black folks and white folks. No surprises here. And I love slash hate this sentence at the bottom of the screen. It says that for every $1 of income earned by white families, they generate $5.19 of wealth, or $5.19 of wealth is created, whereas it's 83 cents for Black families. Anybody want to reflect on that, or take a moment to put together a hypothesis on why we think that is? And why we think that there's a wealth inequality or wealth gaps, or why Black folks kind of go backwards. Um, Auntie Brown said investing versus debt. Yes, that's absolutely a theme that we see. White families have generational access to capital, and there's definitely systemic things such as the GI Bill redlining that has prohibited us from investing and enjoying the fruits of capital appreciation over time, whereas Black people are literally penalized and have been victims of predatory lending schemes where our assets may have been seized for particular technical reasons that the law supports. You know, there's a long history of that. I know we talk about the black tax. So we have certain higher levels of education than our peers, but we may not be promoted at the same rate as our peers. Or when we start businesses, and we see this in coronavirus, we don't have access to the same network or have access to a banker that can get us a loan, i.e. a PPP loan. We, if we are successful, oftentimes we have to feed the whole family. We have to give a little bit of our cash to someone that may have not made the best decisions. So we have to help them out. Um, and I know in my family, neither one of my parents are retirement ready, but they're both retired. So that's something that when money comes in my bank account, I often have to help mom and dad out, um, and I also have to help some of my siblings out as well. So that's, I mean, we all kind of know that story. And so without getting too heavy, well, I'll pause there. Does anybody want to share anything on this particular topic?
I'll jump in, and I think when I grew up in South Central Los Angeles, there was lots of Black businesses. So today we have very few Black businesses, if any. So we're not circulating our dollars supporting those Black businesses either. So that's a big thing for me, is the businesses that we don't have, the lack of in the community to actually support or to circulate the funding, the money.
Yeah, that's right. And we know that some of our small entrepreneurs lack the support and the resources and technical assistance to keep on running that marathon. Gunther says, can you talk about how that affects our youth? Well, in my opinion, and I did not include this slide, but if if when we talk about starting a business, oftentimes you need something called collateral, or you need credit. So when I started my coffee shop, the bank asked me to leverage my house. So it's like, wait a minute. Well, what if I don't have a house? Or what if I don't have collateral? Some of our white peers, maybe they just leveraged their grandmother's house that was passed down to them, or mom or dad might let them take equity out of their home so that they can start a business, right? It's like in our community, I think across the country, 44% of Black families own homes relative to 76% of white folks that own homes in this country. And the start date on those is very, very different. Donna Brown says that the difference in the amount of people with home ownership impacts our net worth 100%. And again, we can't have this conversation without talking about the role of the federal government in rolling out federal housing programming, which we know was not afforded to us. So going back to how this affects our youth, well, our youth aren't given the same amount of resources or bandwidth or social safety nets to be able to try ventures. So the level of expertise that's needed to jump out there, our young people don't have as much margin for error, in my opinion, when we're talking about capital, or even when we start talking about investing and trying to get started, the amount of resources that are available aren't as plentiful. So that's just my opinion on the topic. And we know that home ownership, going back to young people, property taxes are used to fund schools, local schools, depending on the state and the jurisdiction. So the property values in our neighborhoods aren't high, and there's discriminant practices and appraisals, well, the proceeds are going to be lower that go to our schools. And that directly impacts the level and the quality of education that our young people receive. So I do believe that there's a correlation between education and property values because of the use of property values. So I'm gonna keep scooting along unless anybody wants to make any final comments here on this particular topic. Well, I know we don't have that much time to go super deep, but I'm just gonna, lay out, my opinion on some things that we can do today, um, and over time to start reversing this for the next generation and for ourselves. So, how do we make up this gap? How do we make up this wealth gap? And there's so many people, so many think tanks talking about it, and the young people love when I put this in here. I think investing. I think investing is a good solution. I have seven reasons, but we don't have enough time to get into it. But the two primary reasons I think that investing can help is the time value of money, which we'll talk about, and savers or losers, meaning when we explore other options, sometimes saving money doesn't really help us out in the long run. Saving money can actually hurt us if we don't factor in inflation. And we know some of us, when we go to the grocery store, like, wait a minute, I just bought bacon. What? Bacon is just, it's $4 now. Apples. Me and my mom were talking apples. I used to get 6 apples for $1.50. Now it's $3. We see it with gas prices. So our purchasing power reduces over time, and that's how saving can hurt us. We have to make sure that where we're putting our money can keep up with inflation. So, quick game. I love this. This is my favorite thing to do in every single financial literacy presentation I do. This is always in it. So I'm going to take a quick poll of the team of the audience. You can either take yourself off of mute or you can drop in the chat box. Would you take $1 million today, cold hard cash, direct deposit, ACH, in your account right now? Or would you take a penny doubled every day for 30 days? Now, those of us with some wisdom might see a riddle here, but what would you do? Someone take yourself off mute and give me an answer, or pop in the chat box.
Trick, a penny. Penny.
Okay. Winner's gonna take the penny. Aaron's gonna take the million today. Maybe one or two more votes. if you're taking $1 million today, just give me an I. Give me an I. I'm taking the million today. All right. Okay. And those that are taking the penny double, give me a nay. Nay. Okay. All right. Okay. Donna's gonna take the million today in a living trust. Okay. All right. Well, let's walk through it. Let's see what happens. Okay. So the first 1 or 2 days is pretty boring. So just 2 cents. And then, by the end of the week, you're at 16 cents. Like, I think the folks that have the $1 million are like, okay, I'm feeling pretty good. Well, let's give it another 5 days and let's see what happens. All right, $5, not impressive at all. It's not even minimum wage. Let's give it another 5 days and see what happens. Okay, $164. Well, that's not impressive either. That's worthless. Okay, let's give it another 5 days. $5,000. I think the folks there that have the $1 million are still feeling pretty good. Now, $20, 20 days. I don't know. Is it going to be worthwhile? Well, it's going to double again, and by the time we're on day 25, it's 167,000. I don't know. Well, let's give it a few more days. Uh-oh. Now, those that said $1 million, do you want to change your answer? The eyes, do you
Yes,
want to?
yes. I think I messed up. I meant the second one. So.
Okay. All right.
I don't want to change. I don't want to change my answer. I'm keeping mine.
Okay. All right. Don's keeping her answer.
And I'm gonna keep mine.
Can't change it.
Oh, okay. Well, by day 27, the pennies beat the million. And actually, if you would have chose the penny, you would have $5 million. And so the riddle here,
I said, damn.
the riddle here is time. Time matters. Time matters. If you would have started investing at day 5, unfortunately, you would have never gotten to the 5 million. So you can extrapolate this across exercise or effort, or the aggregation of little gains matters. So in my business, we talk about we have to just get 1% better every day. That's all we have to do, because it's the same concept of doubling up. And over time, those little small intentions add up, and that's compounding interest. And this is the value of time. Okay, this is the value of time, and this is why I believe that there's no real get rich quick scheme. Like, if money comes quick, it's going to leave quick. But over time, we let it build and we let it grow. It'll get some pretty strong roots. So let's keep scooting through it, and this is a pretty important chart that essentially exemplifies the power of starting early and consistently investing in the stock market. You have three people, Jack, Jill, and Joe. They all invest the same amount of money every single month, so $200 a month, and they start in 10-year increments differently. So of course, Jack is in blue. Jack starts a little earlier, 10 years earlier than everyone. Jill starts 10 years later at the age of 35. And Joey starts at the age of 45. Now, the retirement age is 65. However, in this day and age, if you're a little older and you're like, oh shoot, well, maybe I didn't start investing at all. It's never too late to start. And the reason why I say that is because as humans, we are living a lot longer. When Social Security was built, folks, the average life expectancy at that particular time was the age 62. Now, the average lifespan exponentially grows every day. So what we need, the amount of capital that we need for retirement is needed. It needs to stretch a lot longer. So it's never too late. It's never too late to start investing. And the key here is consistency in the market over time. Okay, any questions here? Comments? All right, we'll keep pressing along. And again, I put this slide in here mainly for young people so that they can see the power of investing at an early age. And for some of my more senior friends, uh, we all can relate to this. When we were 18, 19, our level of output and energy is represented here in blue. So this is the value, quote unquote, human capital that we're able to offer an employer, or a venture. And as we age, just our productivity just tends to dwindle. And when you're first getting started in your careers, or your earning potential, you don't really have much money left over to save. And that's what's represented in red here. And what we want in an ideal setting is that as our bodies begin to depreciate over time, we want our investments to accelerate and to grow over time. And like we saw with the penny doubled every day, you really start to get some powerful gains later down in the investment lifespan. Charlie Munger, who is Warren Buffett's business partner, says the greatest thing to do with compounding interest is avoid interrupting it at all cost. I don't have the slide in this deck, but there was a presentation that was done around the frequency in which African Americans pull money out of their retirement accounts relative to their ethnic peers. And so Black folks, we pull out of our retirement accounts up to 6 times throughout our career, And ideally, most folks do it when they leave their job, or change companies, or different life events happen. So ideally, we let that money live and breathe. So let's talk about return on investment. And the acronym that I like to use here is called ROI. I'm sure some of you have heard it in the past. And the purpose of this slide is to explore the power of investing relative to saving. So a couple options. Here's some things that you can do with your money. You can put your money under a mattress, of course, which there are literally people that do that. My grandmother included, which, okay, I don't understand, but I'm not 89. I get it. You can put your money in a bank account. We talked about inflation earlier. We are in a high inflation period right now, living through one. You can put your money in municipal bonds. So there's a playground in your neighborhood that needs to get built. The city or the local county will issue bonds and borrow money from its citizens to pay for that park, or to pay for the school or the project. Wall Street, so you can just put your money in the stock market. Or the most risky of them all, well, depending on how you're defining risk, is you can put your money in an individual stock. So let's see how each investment class performed relative to 2018 performance, or or a 10-year average. So if your return on investment with money under your mattress is 0, some can argue that it's actually -0 because you don't get anything in opportunity cost. You could have put that money somewhere else. Well, you all see this at your bank statements. I think 0.4% is generous. If you have money in a Wells Fargo account or Bank of America, you're not getting no money in interest. Inflation, well, then average inflation in 2018 was 2.5%, and over the last 10 years, it's averaged 3.5% a year, which some folks are anticipating that it's going to gain even more. Okay, we got 15 minutes left, so let me hurry up. Muni bonds, you're going to get about just under 5% a year in the stock market. 2018, it was down a little bit. Average 10-year average was 11.5%. Individual stocks like McDonald's, 6.5%, but over a 10-year period, about 214%. So that is pretty powerful. So let me keep on pushing. And over the last 70 years, the stock market has returned 11% on average. Okay. And then we're going to just go through a couple more examples. So over the last 20 years, if you would owned one share of Apple, it would return you 26,000%. That's hard to fathom. Netflix, similar. Kayak.com, Priceline. Amazon, 13, almost 14,000%. NVIDIA, which is a semiconductor company. Nike, the company we all know. Costco, and Marvel, which is also Disney. And just if you would have just put money in the S&P 500, you would have made 260%. I got a question in the chat box comment. No Google. No, I didn't put Google on this list, but we could look it up. And I also want to balance out the conversation that there are losers for sure. Over the last 20 years, Ford had 0% return. General Electric, terrible company. They haven't done so well. AIG, they failed. I also forgot the statistic, but some stocks that have been, I think over the last 10 years, 40% of the stocks on the stock market have been delisted or no longer exist. Which I don't have that chart here. Okay. There is a survey in the chat box. Okay, so I'm going to breeze through this. I wish I had more time. So sorry, feel free to stop me if you have any questions. So just an introduction to the stock market. So when you buy a stock, you're actually buying ownership. So you buy ownership in that company. So when you go to McDonald's and you own McDonald's stock, you're buying, you're supporting your business. Okay. A couple things to know about the stock market. It's an exchange where companies go to raise money. So if a company wants to buy another company, there's a couple of things that they can do. They can raise some debt, they can take out a loan from a bank, or they can go to the public markets and get money from you and me to help them expand their mission. There's two primary exchanges. I mean, there's a whole bunch of them, literally hundreds. But the most popular is the New York Stock Exchange and the NASDAQ. And then when people say, oh, the stock market's up today, the stock market's down, generally they're talking about these three indexes. So it's either the Dow Jones Industrial Average, which is 30 companies, the NASDAQ, which is more tech focused. So a lot of tech companies are in here. And then you have your Standard & Poor's 500. So although they say that there's 500 companies, actually 505 companies. And most people tend to, when they say the stock market, they're generally talking about the S&P 500. And you should know, and all black folks should know, that the S&P 500 is made up of 11 sectors. And I got a slide on that I'll show you shortly. And there's two primary ways that investors benefit from stocks. One, of course, is the appreciation of stocks. So you bought it, like we saw on the other slide, you bought it for $20 a share. Now, 20 years later, it's $5,000 a share. Happens, a few of those happen in our lifetime. Or certain companies pay a dividend. This is a slide or an image that essentially summarizes everything that we talked about in that last slide. Okay, and I'm rushing because of the sake of time. And these are the 11 sectors that make up the stock market. And I got another slide I'll show you really quick that basically shows you how each one of these sectors has performed over the last 10 years. This is where your Apple and your Google and your Netflix, they sit in information technology. Wells Fargo, Bank of America, Goldman Sachs, JP Morgan Chase, they're here. Consumer discretionary, that's Home Depot, Lowe's, Walmart. Consumer staples, this is your Procter & Gamble, Johnson and Johnson. I'm going to keep going. So if you wanted to, what are a couple of things that you can do if you wanted to figure out some stocks that you like? First of all, I think that individuals should hold no more than 5 stocks. No more than 5 stocks. I think if you have more than 5, you're not able to concentrate enough. So one strategy is mind share. Mind share. So if I said car, what's the first car that comes to your mind? Some people say Ford. Some people think of General Motors. If I talk to high schoolers, they're all going to say Tesla. So that may be a good company to invest in. If I say shoes, what company do people generally think of? Nike or Adidas or something like that. Another strategy is pick what you know. Pick what you know. I'm a heavy investor in Square, and the reason why I'm an investor in Square is because I use all of Square's products at my company. We use their payroll system, we use their point of sale system, we use their employee management system, we use everything. I saw how much money I'm paying them a month. I'm like, oh no, I need to be on the other side of this. Some folks like to invest by sectors or by trends. It's like, oh, wow, over the next 10 years, I think technology is going to be the thing. Or some people say, oh, renewable energy. Oh, let me invest in renewable. Or another strategy that people do is they follow the experts. It's like, you know what, I'm just going to whoever the LeBron James of investing is, whatever they say, I'm going to get some investment ideas from them. So those are some entry level stock picking strategies if you just wanted to start today. So which stock is right for you? I think it depends on what you're trying to do. It depends on if it's a short term goal or a long term goal. I'm going to just skip all this because I got a better slide for this. So I think that we all should be focused on the long term. I think that when we're talking about the stock market, we should be focused on the long term. And when I say long term, I'm talking 10 to 20 years, 10 to 20 years, 10 to 20 years. Any comments on cryptocurrency as an investment? I think it's the same. If you're going to invest in cryptocurrency, you should be thinking 10 years out. You should be thinking 10 years out. And that's the safest way to invest in any asset class, whether you're talking about real estate investing, whether you're talking about holding an individual company, whether you're talking about starting up your own business. You should be thinking about your 10 to 20 year plan with any investment. Okay. And here's why. The probability of loss significantly reduces the longer you hold an asset. And when I say loss, that means a stock is $20 and then the next day it goes down to $5. And then the next day it goes, there's just a lot of volatility up and down. So if you've been following the news, Bitcoin has dropped 35% from its all-time high, which is like, whoa. So a more stable investment is like Apple, which is a mega cap company. It's very stable, very consistent. The second, this box on the left essentially says that the longer you hold a stock, your probability of loss goes down over time. So if you hold a stock for 20 years, you have a 0.1% chance of losing money by investing in that asset. And if you look at the notes here, that's over 100 years of data that they're analyzing. Okay. And then we already seen this with your penny doubling example. You have to give time for those investments to cook. Just like Sunday dinner, you can't just pop, some bomb fried chicken in the microwave. No. You gotta cook it. You gotta get that dressing right. You got to let them greens soak. You know what I'm saying? It's the same thing with your investments. You can't keep opening up the oven or you're going to ruin the cake. You're going to ruin the pie. You got to let it cook. And investments need a long time to do their thing and to cook. This chart at the top of the green is where I want to focus your attention here. This is where you get the value. This is where you get the value. And that happens the back end of the investment. And that's the compounding interest. I know I got 5 minutes, so I'm going to keep going. This is a very, very busy chart. This is a very busy chart, but I just want to break this down really quickly. So if you just look in terms of columns, like if we just look at 2007, each row represents a sector of the stock market. So this is energy, this is materials, this is utility, INFT is information technology, this is consumer. And I will share the link if you guys want to look at this. This is the main thing that I want you guys to take away from this slide. The top performer is never the same every year. It's always different. I mean, in the last couple of years, information technology has been at the top. And if we look here at the bottom, in 2014, energy was a loser. 2015, energy was another loser. The last 3 years, energy's been losing. So one might say like, oh, okay, well, then I'm going to avoid energy. But if we look in 2021, the leading sector is energy. It's hard to pick which one's gonna go up, which one's gonna go down. And if you draw your eyes to this light blue where it says S&P, it's kind of in the middle. It's kind of in the middle. So if you're an investor and you value just consistency, the S&P 500 is a good place to start for you. I like Jack Bogle. He's the founder of Vanguard. I love this quote. It says, don't look for a needle in the haystack. Just buy the whole haystack. So he's a fan of just buying indexes, buy and hold indexes over time. And I'm going to show you guys a list of the indexes that I like and that I invest in. And in this chart, you can see just the best and worst performers over time. Some of them have extreme losses. Some of them have good gains. You can just kind of be consistent right in the middle. I only got a few more minutes, so I'm just gonna, I would take a screenshot of this page. Oh, sorry. I would take a screenshot of this page if you can. And these are pretty safe, low cost indexes that I would recommend. My favorite is VOO and VTI. In my personal account, I have 60% of my portfolio allocated to VOO, and then I have another large slug tailored towards QQQ. And it depends on your age, and it depends on when you're getting ready to retire. Right? So if you have a little bit more time to invest, you should be more weighted towards stocks and indexes. If you're near retirement, you should probably shift to more liquidity, more safer investments that aren't going to be so volatile. When I say volatile, that means up one day, down the next day, up one day, down the next day, like cryptocurrency. So if you're about to retire, avoid crypto. If you're about to retire, avoid crypto, or have it be like 1 or 2% of your total investment. I know I'm running out of time. Many young people are using Robinhood. Is Robinhood a good platform to invest in stocks? I hate Robinhood. I hate Robinhood. I hate Robinhood. I hate Robinhood. The reason why I hate Robinhood is because they make money on the float. I'm going to explain it like this. Imagine you're selling water bottles, bottled water in front of USC Stadium. What Robinhood does is they essentially go to Costco and they buy water for 50 cents, and then they turn around and sell it to you for $3. That's what Robinhood does. A better platform, E-Trade's a good platform, and Fidelity. Fidelity has a new program that's out. Let me show you, I know we're out of time, so I'm gonna just these are my favorite books. The book that I recommend for you all is The Psychology of Money. That is an amazing book. That's a wonderful book. I recommend all of you to read The Psychology of Money. The second recommendation that I have is The Money Master of the Game by Tony Robinson. Those are the two books I would read. If you needed a takeaway, you wanted to learn more, that's what I would start. I would start with Money Master of the Game or The Psychology of Money. You can't go wrong with either. Okay, and then Fidelity. Fidelity is a really good place. My personal investments are with Charles Schwab, but they're all pretty competitive.